All right, so kind of a one of those topics that's high on everybody's list is, how to reduce your taxes, and especially in the crypto field. So that's what we're going to talk about today. So I just want to start by saying this information is not intended as financial or tax advice, that it instead is to guide you and share insights you might not be familiar with and clarify aspects you may already be familiar with.
Thank you.
Yeah. Okay, so basically what I'm going to do is give you an overview here of the 11 ways to reduce crypto taxes in 2023. These are the things we're going to talk about, and it may be too much for one day, I don't know. But harvesting losses, long-term investing, take profits in low-income years, give crypto as gifts, give crypto donations, buy and sell crypto in your IRA or 401k, hire a CPA that specializes in crypto, take out a crypto loan, move to a low tax state or country, keep careful records of crypto transactions, and leverage crypto tax software. So are those interesting topics to you all?
Very.
Okay.
Yeah, those are perfect.
Okay. So number one, harvest your losses. So I wanted to put on here that it's important to know that nothing happens until you sell something. So it requires, in order for you to have capital gains or capital losses, there has to be something sold. Tax loss harvesting is intentionally selling your crypto or other assets at a loss. And then you can use those losses to offset capital gains on other cryptocurrencies, stocks, other assets. And then there's an additional $3,000 that you can write off towards your income. And then if the net loss is more than the capital gains offsets, you can carry forward those losses to future tax years. So using the losses to offset your capital gains on these other things, those have to be sold in order for there to be a realized gain. So you have unrealized gains and realized gains. Taxes only happen when there's a realized gain, when something is actually sold. That's an important distinction here. And cryptocurrency is unique, has a unique advantage in tax loss harvesting in that there is no, they're not subject to the wash sale rule. And in securities, if you try to sell something and then buy it right back, you aren't allowed to write off the loss. It has to be 30 days before or after that you buy the other stock, the additional stock. But in cryptocurrency, you can sell it one day and buy it the same day, or buy it before, buy it after.
See, this is an advantage. This is an advantage to crypto user. So Kathy, I would like you to have one page about this. See this, you need to, I will appreciate if you have one page about this and compare with the stock market. You have a limited window, or you have a limit when to sell, when to buy after you sell off certain things. This is beautiful. This is giving the crypto such a beautiful comparison.
Yeah, it's an advantage. So here's a kind of a diagram to show how the wash sale rule works, stocks versus crypto. So you see, can you see my cursor?
Yes.
Okay, so right here, he buys the $1,000 of stock, And then the value of his stock goes down to $500. And then he buys the stock back immediately, and he's not able to claim the capital loss in the securities market. But in the crypto market, you can buy it for $1,000. If it drops, the value drops to $500, you can buy it back right then, and you can still claim the loss. And the beauty of this is that, you know, as things go up and down, there may be, you may hang on to it and then it eventually comes back up. But if you sell it while it's down, you can actually harvest those losses and write off the losses against any gains that you have. So if you do have, let's say, a lot of Bitcoin, and you want to take some of that off the table, you want to sell some and use the money from that sale, you can actually help your tax, and you can wait until toward the end of the year also to see overall what your gains and losses are. But if you get to the end of the year and you see that you have a lot of gains, you can actually go in and say, do I have anything I'm holding right now at a loss? And even if you like that company, you can sell it at a loss, realize the loss, and use it to offset the gains for tax purposes. So does that make sense? Or if I lost you?
No, completely makes sense.
Okay. All right. So another thing is to long-term investing. And so I just wrote this out because I want you to be able to reference it and that kind of thing. But the easiest way to minimize your tax burden is to make sure that you hold your investment, doesn't matter what it is, if it's a house, securities, crypto, it doesn't matter. If you wait 12 months or more to sell your crypto, security, or other assets, the American tax code is set up to encourage long-term investment. So the capital gains tax on profits of assets held more than 12 months will be significantly lower. So here is showing you the difference between capital gains versus capital losses. We're going to talk about that for a minute. And like I said before, nothing happens until you sell something. So when you sell something, that's considered a triggering event. So in order for you to have a capital gain on something, that means you made money in that transaction. You bought it for $10,000. That's your cost basis. That's what you paid for it. And then you sold it for $12,000. Well, you have a capital gain of $2,000. So you will pay the capital gain on just the $2,000. You don't owe it on the original $10,000 you put in. That's why it's so important for you to keep track of your purchases and your sales. And we'll talk about that a little later. But in order for there to be a capital loss, let's say you bought something for $10,000 again, but you sold it for $8,000. So you lost $2,000. That capital loss of $2,000 you can use to write off against any gains that you have, and even $3,000 of it can go towards your ordinary income. So you'd have a tax write-off by selling at a loss. Sometimes people do that just to harvest the losses. Other times people do it because they just need to get part of their capital back, part of their original investment back. They need the money or whatever. So people sell stuff for lots of different reasons, but this particular discussion is based on taxes. So here, I wanted to explain about the capital gain long-term versus short-term. So the long-term capital gain is if you held that investment for 12 months or longer. the maximum tax rate on a long-term gain is 20%. So if you're in the 10% tax bracket, let's say, you would only pay 10%. But if you're in the 38% tax bracket, you would max out at 20%. So on the short-term side, if you hold that investment for less than 12 months, your maximum tax rate can be 37%. It's almost double. So if you had an investment for 10 months and you knew that the difference between holding it for 2 more months could be almost twice as much in taxes, you may want to consider holding it so that you go past the 1 year. Okay, number 3, taking profits in a low income year. So the lower your income during the tax year, the lower tax rate you pay on your cryptocurrency and other asset gains. So you might want to consider when you have a capital gain, you may want to take those gains in years where your annual income is low, like if you were between jobs or you were studying full-time or something like that. So you have opportunities there to sell things in those years and take advantage of the fact that your income is low. So I wanted to show you here the 2023 federal tax brackets and something following that previous slide. The lower your tax bracket, the less you pay percentage-wise of your income. So what I would like to explain here as well is that this is like you fill up these buckets. The first $11,000 is taxed. It doesn't matter if you make $1 million. The first $11,000 up to $11,000 is taxed at 10%. The next 11,000 to 44,000, or if you're married, 22 to 89, is taxed at 12%. And then when that bucket is filled up, you go to the next amount of money. You're subtracting the amount of money that you have already paid in taxes. And so you're not just like, if you make, let's just say $95,000, you don't just jump to the 24% tax bracket. You actually get kind of a graduating increase in your taxes. I don't know if that matters to anyone, but I just wanted to kind of explain that. Okay, so here is
this is the tax of federal tax percentage, right?
Correct.
This is another state, like some states have no tax.
Yeah, Washington, where I live, does not have a state tax, but California does, correct?
Yeah.
Yeah. So the fourth thing on the list there was giving cryptocurrency gifts. And I want to make sure that people understand that if you give your cryptocurrency as a gift or you donate it, it's no longer yours. Like that sounds obvious, but sometimes people look at this as a strategy and maybe don't realize that it's gone out of their state and it's been given to someone else. But the beautiful thing about it is that if you do give cryptocurrency as a gift, you have no income tax obligation on that money. And the fair market value of that gift, if it's $17,000 for a single person or $34,000 for a married couple, if it's over that amount, it may require a gift tax form, but that's just primarily for information purposes. But you are not, there's no tax obligation on your side if you're gifting. You have a lifetime gift amount that you can give, a maximum amount. So if you give over that $17,000 to an individual or $34,000 to a married couple, it goes against your lifetime gifting amount. But that's something that you can do, is gift it. And if you receive cryptocurrency as a gift, you have no tax obligation on that either. So again, it's really important to keep records that say what you got, what the fair market value of that crypto gift was at the time you received it. And that is the cost basis. That is, so you know how we took the amount of money you invested minus what you sold it for, and you either had a gain or a loss. If you don't have that original amount that you paid for it, you could get taxed on 100% of it. So let's say it was a $17,000 gift and it went up to $18,000 and you sold it, you would only owe capital gain on $1,000. But if you did not keep track of that and don't know what the cost basis was, you may have to pay capital gain on all $18,000. So that's really important to keep track of your buys and your sells, even if it's a gift. And then, so I was just saying, remember, if you gift money, securities, or cryptocurrency away, it is no longer yours. It's out of your control and out of your estate. So when people are getting older and they have quite a big estate and they want to minimize the estate tax, they can gift money away or donate it, which we're going to talk about next. And when you do that, it actually lowers the value, the amount of your estate, because it's out of your estate. It's no longer yours. You no longer have control over it. So here, giving cryptocurrency donations is a great way to contribute to a meaningful cause. Donating crypto is a unique time when the IRS allows the investor to double dip on tax benefits. And disposing of crypto as a donation is a unique time when crypto is not taxed. And it possibly can be treated as a tax deduction and potentially reduce your tax obligation. So I wanted to share a strategy with you about donations, about donating, especially low cost basis stock. So let's say you bought Amazon for $1 a share a long time ago, and now it's hundreds of dollars a share. If you sold that stock and you gave the money to a charity, you would owe capital gain tax on that stock you sold. But if you donate it in a charitable remainder trust, you can donate that money. So you create a charitable remainder trust and fund it with that low cost basis stock. So let's say it's Bitcoin, it's cryptocurrency. So you create the charitable remainder trust, and what that means is it is a charity that gets the remainder of what's left in that trust when you die. So if you have something, Ducks Unlimited, or a cancer fund place that you want to donate to, you can name them, or multiple, in your charitable remainder trust, and you can put your real estate in there, you can put stocks in there, you can put crypto, whatever you want. But if you paid whatever you paid for it, like let's say it was Amazon, you paid $1 for it, but now it's worth $100, you get the $100 per share donation amount, and they get a step up in cost basis at that charity. So what that does for a person, so let's say you had Amazon, or let's say Bitcoin. You bought Bitcoin for $1, and now it's $37,000 a coin. That can make a person's estate enormous. And so in order to reduce the amount of their worth in their estate, they can donate that stock, and it is now out of their control, out of their estate. So then you can set it up so that charitable remainder trust pays you income on that money that you put into that charitable remainder trust for them. So when the trust gets the Bitcoin, they can sell it. They can sell it right then. And because they are a charity, they don't owe tax on that. So it went from $1 a share to $37,000 a coin, I should say. And there's no tax to them. They get a step up in cost basis and they can sell it right then. So they're able to use that money then to pay you, the donor, something, whatever is written in the trust. You'll follow the bylaws of the trust. And they say, I want you to pay me, $1,000 a month or whatever. And then you, the donor, go out and buy a life insurance policy for your heirs. You name your heirs the beneficiary of that life insurance policy. Then you use the money that you got from the donation from the credit or the charitable remainder trust, and you pay the premium on that life insurance policy. And so, of course, you have to be insurable. That's a caveat there. You have to make sure you're insurable. But that can be a way to do this. So then, like I said, the charitable remainder trust liquidates the real estate or the stock or the cryptocurrency, whatever it is, and they pay no capital gain on that. So you bought it for $1. It's now $37,000 per token. They get a step up in basis. You don't have to pay the capital gain on it, and they're going to pay you income for as long as you live. Then you get a tax write-off. You get a tax deduction for making the donation, and it is a donation based on today's value. I die, if I'm the donor, when I die, that charitable remainder trust, the remainder, what's left in that trust, is now 100% belongs to that charity, and there's no tax. Charities are not taxed. They don't pay taxes. They're a 503B or a 501C situation. And then, so you take that huge capital gain. Can you still hear me? It was just saying, can you still hear me?
A lot of hiccup. Will be very bad for the recording if you want to use a recording for educational material. So I don't know whether it's the microphone.
Yeah, I don't know. I just got a thing that said that.
I think it's internet related. It doesn't seem like it's hardware. It seems like it's internet related.
It looks frozen.
Kathy, Kathy got frozen for a while.
Okay, now.
It's her internet.
Yeah, it's the internet. That's okay. We were able to catch, I think, most of it there. Maybe only bits and pieces we lost. Can you hear us, Kathy?
Okay now?
Yep.
Huh?
Yeah, we can hear you good now.
Yeah. Saying here, or is it lost?
Now it's good.
Yep. Now it's better. Yeah.
Okay. So did you understand what I was saying there, or do?
Anybody have a question?
Go ahead.
Anybody have questions?
No.
No question.
No
Okay,
question.
go ahead. Proceed.
So.
Uh-oh. She froze again.
So this is the kind of thing that most people are not going to use because, I don't know. Does this happen a lot, or is it on my end?
The bandwidth acts very funny today. Previously, I don't have a problem with you, but this afternoon, when you have a meeting with us, the hiccup started.
Yeah, we have a lot of bandwidth. I don't know. It may be just something with the internet right now.
Maybe the Wi-Fi.
Yeah.
Could be.
Could be. Yeah.
So anyway, do you understand what I was saying here?
Can you mind to explain to them why they need to buy insurance, life insurance? I mean.
Well, because if you donate your very expensive asset to a charity, your heirs are saying, we just lost out on our inheritance, right? But what this does is it allows the donor to gift a low cost basis stock that has increased a lot in value to their favorite charity, and then that charitable remainder trust pays them for their lifetime. And with that money, they're paying the premium on the life insurance policy. And then when that donor dies, the life insurance policy pays tax-free to their heirs. And that value of that asset is no longer in the donor's estate. And so there's a less estate tax owed, and it's just it's quite an interesting strategy. So
they use a life insurance payment to pay the policy, and then use that money to pay the tax.
Well, they actually no. They're when you get a life insurance paid to you, life insurance proceeds paid to you, it is anytime an investment names a beneficiary, an IRA, a 401k, an insurance policy, an annuity, which is an insurance product. Anytime it names a beneficiary, that particular investment, that particular vehicle bypasses probate and goes directly to the beneficiaries. So this money, I took my $1 crypto Bitcoin investment that grew to $37,000, and I donated it to a charity. They don't pay any taxes. It's written in the bylaws of the trust that they pay me income for my life. And with that money, I use it to pay the premium on a life insurance policy that when I die goes to my heirs tax-free. It bypasses probate and goes directly to my heirs tax-free. So that's a pretty cool thing. It's, like I said, it's a strategy that not a ton of people get to use, but some people do. So anyway, should we move on?
Yep.
So here we go. So to buy and sell in your IRA or your 401k. So the IRAs were developed and designed to help you grow your wealth over a long period of time. And if you put money in your IRA or your Roth IRA or your 401k or your 403b, whatever, then that money grows tax deferred the whole time it's in there. And then when you are at retirement age and you go to take money out, it's taxed at ordinary income. So there are a lot of, most IRA providers don't accommodate cryptocurrency, but there are ones that do, and they do that through a self-directed IRA. Like I put here, iTrust Capital, Bitcoin IRA, Coin IRA. So the thing that's special about those is that they can hold things other than just securities. They don't hold just stocks and bonds and potentially an annuity or something like that. In those self-directed IRAs, you can hold real estate, precious metals, and cryptocurrency. So that makes it kind of unique. But you can do this self-directed IRA in order to hold cryptocurrency. So do you have any questions on that? On the self-directed IRA? No. Okay. So let's talk a little bit about the traditional IRA versus the Roth IRA. The traditional IRA, you get the tax break now. The Roth IRA, you get the tax break later. You don't get a write-off when you make a contribution. So the traditional IRA, you pay ordinary income tax on any distributions that you take. In your Roth IRA, that money has stayed tax deferred the whole time. And when you take distributions out, it's tax free. So the younger a person is, the more benefit there is to the Roth IRA, because you have a longer time for things to grow. So let's just take the Bitcoin example that we used before and say if you put a $1 Bitcoin in your Roth IRA, back in 2010 or whatever, 2009, and it grew to $67,000 and you took a distribution. After you're 59 and a half is when you can take distributions without penalties. But you take a distribution, it's tax-free. The amount of distribution you take is tax-free. So I'm gonna go over here to the traditional IRA side and just go down the list and talk about that. So traditional IRA, you make a contribution, you get a tax write-off. So right now it's $6,500 a year that you can put in there, or $7,500 if you're 50 or over. You pay ordinary income tax on any distributions. So when you take money out, it becomes part of, like if you had a W-2 or some other kind of income, it's taxed the same way. If you take it out before 59 and a half, there's a 10% penalty for taking it out. But there are exceptions, and I've listed those there: medical expenses, health insurance after layoff, that kind of stuff. And then the government says, okay, you have had this money in tax deferred in your IRA for all these years. By the time you're 72, we're going to say you have to start taking distributions. You need to get that money back in the taxable realm. So they do what's called the required minimum distribution. It's a calculation they do, and you have to start taking the money out. It's designed for you to get your IRA to zero. It doesn't work that way, but that's what it's designed for. So on the Roth IRA side, you get a tax break when you take money out. When you put taxed dollars in, so you don't get a write-off. And there is an income limit on a Roth IRA. So if you make $153,000 a year and you're single, or $228,000 a year and you're married, if it's below that, you can make the contributions. There's kind of some staggering as you go kind of thing, but you can withdraw the contributions, not the earnings, but the contributions, without any penalty if the assets have been in there for 5 years or more in the Roth IRA. And not only can you continue to make contributions after 70 and a half, but you don't have to take a required minimum distribution. So the contributions after 70 and a half, you have to have earned income. So that's one of the qualifications there. But the traditional and Roth IRA, you may have do you have any questions on that at all? No? Okay. So this solo 401k was something that I thought was really interesting because there are no age or income restrictions. You have to be a business owner, but you know, some people, I don't know if you are considered business owners as you know, being in the hive and all that. Are they 1099? Or
Correct. 1099. Yeah.
yeah. So you would be then considered a business owner, kind of a consultant thing. So if you have no employees that work more than 1,000 hours a year, so approximately 20 hours a week, then you qualify for this solo 401k. This is kind of out of order. I want to go here. So see this solo 401k contributions, you can put up to $66,000 a year into a solo 401k and not be taxed on those dollars. So if it's a, you can do Roth IRAs or traditional IRAs. It gets kind of complicated, but I just want you to know that there are these options, that there are ways that you can really minimize the amount of taxes you pay because you have the opportunity as a business owner with no employees to make a contribution up to $66,000 a year and an additional $7,500 if you're over 50. But there are other, you can, in a traditional 401k, like if you have a job, you're doing that, you can do $22,500, but you can see that this solo 401k allows you to get that $66,000 out of a taxable situation. So let me go back then.
Hey, Kathy, do you do 401k, all these set up for people in case there is a Captain B who's interested in doing all these suggestions?
No. Okay. No, you would have to go see a financial advisor.
Yes. Anybody work for BlackRock or Fidelity?
Well, no, you can, there are, you know, a lot of tons and tons of financial advisors out there that work for lots of different companies, lots and lots of different companies. But
they all licensed.
Oh, they have to be. Yeah, they have to be licensed. Yeah. So, and so these strategies are just an introduction to you to understand enough of it to go to your financial advisor, your CPA, or your attorney and say, you know, well, if you wanted to set up an IRA, a 401k, a solo 401k, whatever, you could be advised by your CPA, your attorney, whatever, but you need to go to a financial advisor and get those things set up. You can do it on your own. It's just really valuable to have a professional helping you on those things. So this backdoor Roth IRA, you know how I said that there's a limit on the amount of income a person can have in order to make a contribution to a Roth IRA? The way that you can get around that and get your IRA money into a Roth IRA so that you have tax deferred growth and then tax free when you take it out is you can do this, what's called a backdoor Roth IRA. And it's a strategy used for high income earners who can't contribute to a Roth because their income is above the limit. So instead of contributing directly to a Roth IRA, they contribute to a traditional IRA and then convert it to a Roth. And this is called a Roth conversion or a backdoor Roth IRA. So this is really important right here. You pay ordinary income tax on the amount you convert in the year of the conversion. So you can do it, and from that day forward, the amount you contributed is taxable because you're taking it out of an IRA and putting it into a Roth IRA, which is taxed money that goes in there. Does that make sense?
Makes sense, but who will do that?
Well, people that want to, they're young and they want to, they know that, you know, if they make too much money right now, then they want to get that into a vehicle that is going to grow tax deferred. And then when they reach retirement age and they start taking income, it's all tax free. If they're expecting that they're going to be in a higher tax bracket when they retire. Yeah, it's a decision that you would definitely want to talk to your advisor, your CPA, your attorney, somebody about, because everybody's situation is a little bit different, right? The details.
Yep.
So but I just want you to know it's a thing. It's available and it is something that can be done. So, okay, and this is just, we can avoid this actually, but it's just talking about the power of compound interest. So when you look at something like a Roth IRA and see this guy right here, he saved $1,000 a year for only 10 years. But he started at 25 and he saved $1,000 a year until he was 34. And then he didn't put another dime in there. So then, oh, and I can't see my side of the screen. Can you see the whole thing?
Yeah.
Yeah, we can see the whole thing.
Yeah, we can see.
Okay. Well, anyway, so it grew to whatever the amount is there, 157,000 or something. So his total investment was $10,000. Here's this guy that he started at age 35 and he put $1,000 in for 30 years. Interest rate, and he ended up with less money than the person that started 10 years earlier and only saved for 10 years. So this is just to drive home the power of compound interest. And so what Einstein said was compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So, you know, it's just a very important thing to understand when you're growing your wealth. So that's just kind of a fun little thing. And then this is a fun rule. I like this rule. This is just like a quick calculation that you can do. It's the rule of 72. If you take 72 and divide it by the interest rates you're getting, that tells you how long it takes for your money to double. So if you're getting 12%, you take 72 divided by 12 is 6. That's how many years it takes you for your money to double. So if you get 2% on your money, it takes you 36 years for your money to double. So the amount of return you get is, you know, the amount of interest you are getting will determine how long before you get a double. Before your money doubles. So that's just a nice little rule to know. That's called the rule of 72. 72 divided by your interest rate tells you how many years before your money doubles. Okay, just kind of fun. Okay, so number 7, hire a CPA specializing in crypto. It's money well spent. It may be something that you have to kind of bite the bullet at the beginning, but I can tell you, we have a CPA that multiple times over earns what he charges us by what he's able to do for us with, you know, tax strategies, savings, all the things. It's just, bless you. It's just very, very much money well spent when you start getting into a little more complex type of tax situation. The other thing you can do is get a loan. You can get cryptocurrency loans. And instead of selling your cryptocurrency, which, like we talked about, could lead to a large tax liability if you have a large capital gain, you can use your crypto as collateral for a loan. And taking out a loan is a non-taxable event. So it gives you access to fiat money. You can go out and buy stuff without a tax bill. So there are only certain banks that will do this, but it is something that you can do. So if the value, I just want to put a caution out there. If the value of your cryptocurrency drops substantially, let's see, they may end up having to sell it to make sure that you have enough money to cover the that the collateral is there in place. So it's considered a disposal or a sale, and taxes would be owed on any capital gain that you might have. So for instance, if you bought Bitcoin for $1, it went to $37,000, and you got a loan on $35,000 of it, and then it dropped to $10,000, they may say you don't have enough collateral here, so we need to liquidate in order to cover that, and that would be considered a sale. Here's a pretty dramatic one. You can move to a low tax state or country. So some states don't have any income tax, like Washington or the ones listed there, or you could move to the UAE or Malta. So, that's a pretty dramatic thing, but it is something people do sometimes.
Portugal for crypto.
This is what we talked about before, keeping. What's that? What's that, Gabe?
I said Portugal for crypto.
There's a lot of crypto millionaire who make them $1 million income in California. They migrate to Puerto Rico.
Yeah, it's what some people do if it's the incentive is there. Did I lose you guys? Am I frozen?
We're here.
We're here.
Okay, because I just got another notice that the bandwidth was unstable. Okay, so if you lose track of your original cost basis, like we were talking about before, you may end up having to pay taxes on the entire amount. So once again, if you bought something for $10,000 and you sold it for $12,000, you would only have a $2,000 gain. But if you can't show that you bought it for $10,000, you might have to pay capital gain on the whole $12,000. And if it was a short-term deal, it could be very expensive, the 37% or whatever. So it's really important to keep track of your buys and sells. And the dates are important as well. The other thing that I can tell you, we're just in the process of settling my husband's parents' estate. And if you don't have a cost basis, if you don't have a record of what you paid for stuff, and you still own it when you die, I know you guys are all young and all that stuff, and I keep talking about dying. But it's really important that the cost basis is that you have the cost and the dates and the time of the purchase and the receipts and the disposal. So you need to make sure that you keep track of those things. And number 11, last thing, is using crypto tax software. It saves a ton of time. It can automatically import transactions from the exchanges, and it generates a very comprehensive tax report in just minutes. And it can help you find the biggest tax saving opportunities. So it's a very good thing to use. And once again, this is not financial advice or tax advice. It's just to give you some ideas of things that you might want to talk to your CPA or your attorney about. So.
I like it.
Yeah.
Very meaningful.
It's a lot of information, and it sometimes is, you know, kind of like drinking from a fire hose, but it's just
sometimes drinking from fire hose make you feel full quickly.
Yeah, yeah. So anyway, I'm going to stop this share. There. Wow. That was a first.
You're Zoom Pro now.
Yeah, see that? Professional. So anyway, do you guys have any questions about that stuff, or?
No, it's very good. Even for me, it's refreshed my memory a lot. Sometimes sometimes you don't have time to talk about this. You assume you remember all, but refreshing.
Yeah. Good. And it may be, you know, sometimes when you're talking to people, like if you have an interested investor, and you know, there may be like something comes up with that particular investor that it's like, you know what, there is something about that. Let me find out, because I know you can put crypto in your Roth IRA, or I know that you can harvest your tax losses, but let me find out more about that, you know, and what a good strategy might be or something.
Yeah, and one that you brought up, and I didn't even really realize, was that you had mentioned the wash strategy. You know, I knew you couldn't do that in the stock market, but I never realized, I never even applied that strategy or even thought about applying it within crypto. Being able to sell it at a loss and then rebuy it at that loss to claim the capital losses. I had never even thought about that. I didn't even know it existed.
Yeah, I didn't either until
that's a part of a benefit of Wild West.
Yes.
Yeah, the law haven't applied to this situation yet. Does not mean they will never come.
Right.
So enjoy while you can.
Yeah. Yeah.
Very interesting. Definitely learned something.
Good.
So therefore, by talking about this, I think we had a plan for Gabe to present our Wall Street. I think I recommend we postpone this presentation for later on, since we had a very good feature, but I don't know how to sell them from Wall Street, which is the staking. When you buy stock market from Wall Street from the traditional way, you just buy the stock follows the stock you purchase, go up and down with the market performance. But since we're the crypto, we made the crypto token, for example, crypto token of Apple. Now, when you purchase this crypto, the value of the crypto follows Apple's performance. But at the same time, we also have a feature allow people to staking, doing this inside of Indexx staking. That means the person bought the crypto, the stock crypto token can double dip. You can dip, you can buy the token, but you also dip from the 15. We haven't figured out this yet, and Kathy specifically said, hey, if I can make interest, people assume you're using my money to do some investment. Otherwise, how can I make 15% or even 3%.
Right. So what I was referring to too, just a general understanding of stocks versus bonds, that if you buy a stock of a company, you're literally buying part of that company. You're buying into that company. If you buy a bond and it pays you interest, what you're doing is you're loaning that company your money. So if you buy a CD at a bank, if you buy a general obligation bond at a municipality, whatever kind of bond, sometimes companies have them, they'll issue bonds to raise capital, and then they pay you interest. And that is their way of compensating you for loaning them your money. So a stock, you own part of the company. A bond, you're loaning them your money and they pay you interest.
Now, she is making perfect points. Now, Gabe, think about the stock you bought, you're making money with the performance already. We sell you this token to represent this stock. We did not make any money besides 3%. But we make 3%, you bought the token, now you staking us, you make 15%, it doesn't make sense. So the percentage of stock token need to adjust. Even they come to do the staking with us, we cannot afford to pay 15%. We can only afford to pay 15% on INES type token.
Yeah, I don't think we should stake that.
No, it's 15% only on the INEX token. That's the only thing that has 15%. Everything else is 5%.
If we don't, Nick is saying we should not do the staking, allow the stock token do the staking. If you don't allow them to do the staking, you are just an ordinary stock market. You are only use crypto to cryptolize the stock, but you are not taking advantage of the stock token. The token you can do staking. So I'm thinking about you, why we're so unique. Besides, use ERC20, which is the Ethereum blockchain token protocol. What about making little staking, little bit better than buying ordinary Apple stock? That's what I try to do.
So what I thought when you were saying that, it's tied to that to the stock market and the movement of that company in the stock market, but yet you're making 15%. To me, that is why would you be giving me 15%
if you're not taking my money to be useful?
If you're not using my money to do something with it, and also the message that comes with a 15% return is there's a high level of risk associated with that, right? So, yeah.
And
I love that thought, but we understand.
Okay. So what I'm wondering is why just being able to buy stock with your crypto within that platform of Indexx, why that isn't enough.
When I say that, it's for the first year, while Indexx just opened to the ordinary marketplace, we're willing to do little extraordinary service and benefit. But in the future, we may not do that. Okay. But in the first year, while we're still growing, I'm willing to open this opportunity. But you're right. I don't want to offer something so with the generosity and make it suspicious out of a public. That is a dumb and dumber decision.
Well, okay, yeah. So
and just so we're clear, everything outside of the Indexx INEX token, other than the IUSD, because IUSD is a stable token, everything else is 5% for 12 months. The only thing that's 15% out of all of our tokens across the entire ecosystem, the only thing that's 15% for 12 months is the INEX token.
okay, so is it interest or is it a dividend?
It's an interest yield.
It's an interest yield.
Yeah, but it's a guaranteed interest.
So why is there interest on a stock purchase?
No. Good question. We're not saying we have to do it right now. It's a concept. Shall we put in to support people to buy from us instead buy from Fidelity or buy from Nasdaq?
But I think
Robin Hood.
Yeah. So what I can say about that is that this is where the benefit of the personal relationships that you have with the investors you bring to the table. So if you have a choice of 100 different people to 100 different platforms that would offer to buy stock with their crypto, that relationship that investor has with me personally is why they come to Indexx. That's why I think the hive and having people direct marketing and selling on a personal level is really good, because the amount of trust you have in that person, that's why this education is so important. Because it instills a sense of confidence and professionalism and gives people, like, I want to do business with you. I want to do business with you because I trust you, because you provide good service, you're knowledgeable in you give me good ideas. There are those reasons. That's why it's so important for our people to be educated in this, know what they're talking about, develop the relationships with people. That's why people invest with us, not because we're paying 15% or 5%, but because they have the relationship with us and they're able to buy a stock position with their cryptocurrency. They're able to participate in the stock market idea with their cryptocurrency. So to me, if like you're saying to offer 15%, my red flags go up right away, because I'm thinking I don't get it. And I know there are probably people that say, yee-haw, 15%, that's great. But they don't understand that with high interest payments comes a higher level of risk. And so I just don't want you to send the wrong message,
No, it's good.